Hey, good afternoon, everyone. Hello.
Good afternoon.
Yeah, hi. Is it Jason?
Yes, yes.
Oh, and that's spelled in a it must be pronounced Jason, but spelled in a little um, a unique way.
Thank you. Thank you,
Uh,
sir.
so how's everybody else? Is there a Yosahani? Is there a Yosahani?
Yes.
Hello. Yeah,
Hello.
how are you?
I'm good.
And yeah, is that correct, Yosahani? The way
Yeah,
I
you're saying it correct.
okay, thank you. And Michael, are you there, Michael?
Yeah, how you doing?
Good. How are you? How about you, Cedric? Are you there, Cedric? Cedric, how are you, Cedric? I guess either you're not there or you have uh, you don't know how to unmute it. Uh, Brian, are you there, Brian?
Yeah,
How
I'm
are
here.
you? Good, good. How are you? Now, I see at least 8 people here, but let me, um, uh, before I join the collaborate session, I quickly checked the discussion board, and there weren't 8 people. There were, I guess, less than. Alrighty. So it looks like there are, yeah, 7 people in the discussion board. Um, it says 9, but 2 of the postings are mine, so there are 7. But there are 8 in the collaborate session, not right. So that means at least one of you didn't sign into the today's forum. Now, in the tour video, right, there was before this first class started, I sent out a couple of emails, and one of them was a tour video. Of course, in the emails, it was whatever was discussed in that tour video, and whatever instruction was there in um, the emails that were sent out prior to the beginning of the first class. They can be all found in the also in the announcements folder. But one of them was class protocol, and the class protocol clearly states that the first order of business is to sign in to the discussion board and report your attendance. Okay, uh, I stated it very clear there that um, that is the physical proof of your attendance. It's like It's like signing into the sign-in sheet, right? So if you didn't do that, uh, please uh, please go ahead and go to the discussion board and sign in there, please. Okay. Later on, I'm not gonna. Um, there's no way I can retain in my memory who who are in this collaborate session. Okay, that's not gonna help, right? Um, Only the physical proof of your attendance will help to um, take your attendance record. Okay. Now, so we're going to be, and today is 8:30, and you guys are section 1300. All right, so you're going to be first, okay, a couple of more people, so that means 8, and we have We have 11, right? So it's 3 people. That means 3 people haven't signed in yet. So please don't forget. First order of business is to sign into the discussion board, right? To sign in, leave your attendance report in today's forum. Okay? So please do this. Okay? Please don't. And I hear somebody must have Michael Garcia. No, you don't do it here. You must do it here, right? It must match you must create, if there is Michael Garcia, please please do your report here. It has to be counted, right? When I cannot look into, I cannot check this number and look into my posting just to, I will just check who's attending or not, who's present or not, just by looking at the names here. Okay, so Michael, Michael Garcia, yeah. Michael, please create your own thread. Okay, Michael. Now, so let's go to let's see. Let's go to today's topic, right? And of course, if you go to the course materials, right, and this is the only folder that is visible to you, and as of today, last Wednesday, there were only 2 videos, right, last Wednesday, and it's only because you had, we have 1 hour class on Wednesday, right? And we have 2-hour session, right? So we have, ROI part 3 through part 6, right? Each of these videos are 30 minutes long, so that means 4 of them will make 2 hours, right? But of course, these are, I should reallocate these, I should reallocate these, video numbers, right? Number of videos, because anyway, you are supposed to study them ahead of time, in advance. So for Wednesday's class, you should, for Monday's class, you have the whole weekend after Wednesday, previous Wednesday, right? So I should allocate more videos, right? Instead of 2, I should allocate 4 on Wednesday, so that you will have watched all 4 videos for the discussion on Monday. And as I said, and this is one thing most of you, this is one thing that you should be clear about. And I mentioned this also in the last class, that the Collaborate session is not the main lecture. Okay, the main lecture is the pre-assigned videos, right? The main lecture is delivered through the pre-assigned videos, and I've been telling you this. I've been emphasizing this since before the beginning of the class. The Collaborate session is like an afterglow. Okay, Collaborate session is for reviewing and reflecting on the pre-assigned reading. I mean, we don't have reading, we have videos, right? So the videos are the main lecture, and you will you will have watched all of those pre-assigned videos, and then uh, in the collaborate session, in the following class, we reflect on the pre-assigned videos, right? Just like, pre-assigned readings, but we don't have any. Instead of reading, it is, watching videos in this class, for this class, right? So you had only 2 videos last Wednesday. So actually you have um, uh, 4 videos that were just assigned today. So then, that means this coming Wednesday we'll be discussing, and reviewing part 3 through part 6. Okay. And without further ado, let me just quickly check if you guys are all, if the numbers are matching, right? Numbers between the those who are in the collaborate session and the no, again, who is the third person here? The second person. Ralph, is there Ralph? Ralph? Okay, it seems like Ralph is not even here. So, Ralph, you need to do the same thing. You have to create your own thread. Let's see if Ralph has done that. No, this is the problem. All righty. So, and then, so there are 13 people, except those 2 postings, right? Which are mine. 13, and including Ralph, there should be 14. And the number of people here, only 11. That means only 10 except myself. So 4 are still missing. 4 are missing, right? And some people are, it's obvious, some people are having, connection issues, right? Some of these people are reconnecting or just joining. But I'm gonna come back to this attendance issue, right? Attendance report issue later on. But since we are, it's already 16 minutes past the hour. So let's go over, let's reflect on what was discussed, in the first lecture, right? So the first thing we talked about, or I talked about in the first lecture video, is the return on investment, right? And it is obvious, return on investment or return, right? Return, ROI, return on investment, is the single most concept and central concept of finance, right? Think about it. The only reason, the main reason, not the only reason, but the main reason you are investing in financial assets such as stocks and bonds, the single most important, or the main reason you are interested in the finance is ROI, return on investment, and the goal of investing. I'm not saying goal of finance, but the goal of investing is to maximize your return, right? Of course, that's only on the that's only the part 1, and there's part 2. If possible, and you want to maximize your return while you're minimizing the risk, right? But the goal, yeah, these two goals can be achieved. These two goals may not be achieved at the same time. You may maximize your return, but it doesn't necessarily mean you can minimize risk at the same time. Why? Because as the old saying goes, the higher the return, um, the higher the risk, right? It's just like the same thing as no pains, no gains. The greater the pain, the greater the gain, right? The greater the risk, the greater the return, right? But then the question is, do we need to take on the greatest risk to get the greatest return? I would say not necessarily, but the chances are most likely you will have to bear greater greater risk to get greater return, right? But then even if that's true, if it is possible, right, to contain, or even if you can, let's say, hold risk at the minimal level possible. I mean, minimal doesn't mean it is the absolute minimum, but for the return. I mean, if you get 20% return, right? But to get 20% return, the risk there. Suppose you have two stocks, right? Suppose you have two stocks, X and Y. Okay, stock X. The return is, and it's actually expected return, but it's a concept that we will have to discuss again later. So let's just call it return. Let's say the return is 20%, and the risk is 30%. Whereas stock Y also has 20% return, but the risk is 15%. Okay? Then between stock X and stock Y, which one would you prefer? Which one would you pick? Anybody? Stock X, and we have two stocks, X and Y, and both have same expected return of 20%. But X has the risk of 30%. Y has the risk of 15%. Which one will you choose? Anybody? This is quite a yeah, Yosahani, yeah, stock Y, Yosahani, because it has less risk. Yes, it's a common sense. Think about it. Who wants to? I mean, if the return is the same, for both of them, if the returns are the same, then the criteria will be which one has lower risk, right? Goes without saying. So Yosahani, I will give you 0.25 points for that for that answer. Okay, it is not a very challenging question, so the answer is quite obvious, but only Yosahani. Now, please if possible, please use your microphone, because if you let's say when I'm looking at this file, then I cannot check what's going on in the Collaborate. I need to switch back to Collaborate, to find that. Okay, so let's if you if you can, please, unmute your microphone, right? All right, back to, yeah, and then think about it. Now, let's tweak the scenario just a little. Tweak the scenario just a little. So now we have stock X and Y, and they have stock X as they both have now the same risk. They both have the same risk of 20%, and then stock X has the expected return of 15%, while stock Y has expected return of 10%. They both have the same risk of 20%. 20%, risk of expected return of 15% or 10% is not that difficult to understand, right? Because that means that's most likely what you will get. That's what is expected, the return that is expected. But what does that mean? Risk of 20%. What does that mean? That means it has a average variation, right? On average, the variation in the average variation in the stock's return is the 20%, left and right? Between that means if the expected return is 15%, right? That means it can swing 20% to the right or to the upper side, and 20% to the lower side. Okay. So, but that's not the end point. It's just with the probability of 68%, you can swing 20% above the expected return of 15. That's going to be like 35%, right? And with the probability of another, so with the probability of 34%, it can swing 20%. It can be distributed anywhere. The return can land anywhere between 15 and 35%, right? And then with also 34% probability, it can land anywhere between 15 and minus 5%, right? So you might wonder, then why is it? If you can, if there is a 34% probability that your return can be anywhere between 15 and 35%, why is that a risk? It's still a risk because it's unpredictable, right? Any unpredictable deviation from the expected return is a risk. Any unpredictability is a risk. Okay, you might think only the chances of getting something lower than the expected return is the risk. That's called downside risk, but even the upside is the risk, because anything that will deviate from the expected return is the risk. So let's get back to the same scenario. Tweaked scenario. So now both have the same risk of 20%, but X has the expected return of 15%, and Y has the expected return of 10%. Then which one is your choice? Which stock is your choice? Anyone?
Hello?
Yeah, go on.
It should be X, stock X.
Yeah, it should be X. Was that what? who was that? Was it Jason
It was
or
me,
who said that?
Antonio, with the mic on.
Antonio. Okay, Antonio. All right, Antonio. You got also 0.25 for that. Maybe other people. Look, I told you I cannot. Look, I was here. Please use your good sense. I was looking at this, right? As I was looking at this, then there is no way I can see what's going on in the chat box. So if you drop something in the chat box, I can't see. And if someone says, if someone gives me an answer verbally, then that person gets the chance. Okay? Use your good sense. How can I see what's going on here when I'm looking at that? Right? I have only one monitor, one screen. Right? Keisha, okay, your audio isn't working. I'm sorry about that, but you will need to get your audio. You will need to fix that problem. Okay. Yeah. Well, yeah, you might need to restart the browser, or you might need to restart your computer, right? So I'm here. The class doesn't go away, so please, please take your time. And okay, somebody's knocking at the door. So please, I gotta put you on a hold. 5 seconds. All righty. So where am I? Where was I? So here, yeah, the concept. Think about it. If you think about it, these two examples I gave you are giving you a clear idea of asset selection criteria, right? Why? First of all, first case was when returns were the same but different risk, right? Second example was about the same risk but different returns, right? But if you think about it, they all confirm the concept of maximum return for minimum risk. In other words, how do you minimum? You cannot you cannot pinpoint what is maximum or what is minimum, but given the current price data, and given the current price data, you can calculate return and you can calculate risk, and then based on that, the best you can do is to achieve and given the price data of, let's say, X number of stocks, or let me put it, N number of stocks. N can mean any number, right? So let's say you selected the best performing stocks from 10 different industries, best performing stocks. And so what was your criteria for selecting best performing stocks? Obviously the return, right? You have the price data for the last 5 years, and the price data is in monthly data format, monthly. So that means monthly data means at the end of the month, price at the closing of the market at the end of the month. So you have like for 5 years worth of data, right? You have 5 years worth of data. That's like 60 data points, right? Isn't that right? Because 1 year is 12 months. You will have 60 data points, and then with 60 data points, you have you can calculate why is it that I think it is. Oh, come on. Okay, I better not use this one. So with 50 data points, you can calculate, average monthly return, right? Which will be used as our expected return. And then you can calculate the risk. And so you do this for like these 10 companies, each representing each industry, right? So 10 industrial sectors. So you select, these 10 companies based on their, returns, right? Then, it will be ranging. Obviously, one of them will be the top performer of the. You can stack them up. You can stack them up. You can stack up these 10 companies in terms of their return. So the highest return will come on top, of course. Then the lowest return will come to the bottom. But then also you have their risk data, and then you will notice that they will be all uneven. They will be all different, right? They will be all different. But you will soon notice that just stacking up in the ascending order of the return will not be a perfect criteria. Why? You will also notice that that's only one sorting criteria. The other sorting criteria is risk. I mean, by risk, then you will see that the lower that number, the better it is. Isn't that right? The lower that number, the better it is. And then if you sort it, in ascending order, that order will not match, right? That order will not match the stacking of returns. And you will also, if stock X was the best performer in terms of return, but stock X may not be the best performer in terms of risk, because stock X must have a very high risk. It may not be the last in terms of the order of risk. It may not be at the bottom, but it will be in the lower section of the of that stack, right? But then how do you prioritize them? I mean, how do you know which one is the best? Well, we'll have to think in terms of efficiency, right? We'll have to think in terms of efficiency. So how do you measure efficiency? Now, it's the same concept as the gas mileage, right? What is gas mileage? Can anybody give me the answer? What is gas mileage? You all know what gas mileage is.
Isn't it gallons per mile?
It's gallons per. No, actually, it's the other way around. It's the other way around. And who said that? Who said
Keisha
that?
Anderson.
Okay, Keisha. Okay, Keisha, you got 0.25 for that. Yeah, it's actually the inverse of that. But that's also correct because only in the U.S. it's gallons per mile, right? But in most other countries they use the inverse gas mileage. They use liters per kilometer, right? In other countries, but in the U.S. it's miles per gallon. And you can easily understand why it measures the efficiency. They also call that fuel efficiency or fuel economy. And obviously we all know. So how do we calculate gas mileage? We all know it's you fill the tank, you fill the gas to full in your car. Of course, it will depend on how big your gas tank is, but regardless, I mean, if you have a small car, maybe 13 gallons will be max. If you have a big car, maybe 15 gallons or even 18 gallons. I don't. But the idea is, just because you have a big tank, it doesn't mean it will take you the farthest, right? Just because you have the biggest gas tank, it doesn't mean it will get you the farthest. Why?
Because
Obviously,
it depends on the it depends on the car and how much gas it intakes.
Yeah, but there's a word for that. It depends on the gas mileage, isn't that right? Exactly, it's the gas mileage, right? Yeah, if you have a car like V8 engine, 5-liter V8, gas guzzler, a huge, SUV like Escalade, Cadillac Escalade, or what's that, Ford, Expedition, or these cars get what, do they get even 10 miles per gallon? Huh? But on the other hand, there are, hybrid, or even if it is, not hybrid, gasoline engine, small cars, with, turbo engine, they have very high fuel efficiency. In other words, they have very small tank, probably 13-gallon tank, but they get, probably 600 miles on the full tank of gas, or 800 miles. 800 miles if you have 20-gallon tank. If you get 800 miles, that's 40 miles per gallon. But basically, we know how gas mileage is calculated. You fill up the tank, gas tank, and you drive until you run out, and you divide it by the total gallons that went into the tank. And obviously, the higher the number, the better it is, or the more efficient it is, the more efficient the car is. And is there anybody who would be against better gas mileage? Is there anyone, right? I don't think anyone would disagree, right? Gas mileage is one important fact, a single most important factor. Of course, some people, when they are buying cars, they look for, safety, creature comfort, ergonomics, creature comfort, other features, But those are all. I would say those are all auxiliary features or functions. Most people would consider the gas mileage as the most important factor, right? So it's the same concept if you think about it, right? Risk is like the gallons, right? Gallons of gas, and the miles you get is the return is like the miles you get. So The reason, let's think about it. Why am I talking about gas mileage here at this point? Well, because I set forth, right, at the beginning I set forth, you want to maximize your return. But maximizing the return has, a constraint because you have risk. So given the risk, right, how do you maximize your, even if you think about it, you have, like, Ford Expedition, which is a huge SUV, big engine, or Cadillac Escalade, big engine, big car, very comfortable. But then it gets only, and you drive, you filled up your, gas tank, and then drove all the way until you ran out, and you got, you drove 400 miles. You drove 400 miles, and you ran out. Is that the maximum you can do? Yeah, that's the maximum for that car. Or maybe you got, 500 miles, right? But then that's the maximum. So, there's another car, and your friend has a small, small, let's say, small car. Let's make it, comparable. So don't think about, electric vehicle or hybrid. Just a gas engine, a combustion engine, gasoline car, small one. What could it be? I can't think of anything small right now, but let's say Hyundai, Kia Forte. Forte is not, Kia Forte is, I believe, not a very big car. It's a small car, but, not very, not too small. It's kind of, but anyway, compared to, everything is small compared to Ford Cadillac Escalade. But let's say, and Kia Forte is, let's say you got also like 400 miles on a full tank of gas. So they both got 400 miles, or Escalade got 500 miles. It got 100 miles more. But then, can you say Escalade did better than Kia Forte? Because if you have, what you need to consider is, so how many gallons did it take to, get 400 miles or to get 500 miles? And Kia Forte must have, small cars generally have about 13-gallon tank, I believe. So to make it simple, let's say 10-gallon tank, and it got 400 miles, right? When it ran out. Then what's the gas mileage then? 40 miles per gallon. But on the other hand, Escalade, it got 500 miles, but it's got a 20-gallon tank, let's say, a 25-gallon tank, just to make it easier. So on a 25-gallon tank, if you got only 500 miles, then what's the gas mileage? Then it's 20 miles per gallon, right? So then who did better? It's obvious, Kia got better, Forte got better, did better. It clearly did better. It's the winner in terms of efficiency, fuel efficiency, right? You understand that? That's basically the concept, because although you can stack up these 10 stocks in terms of their returns, but the constraint is their the gas consumption, right?
So I have a question.
Yeah.
Does this mean that it doesn't matter if the return is high if the risk is even higher? Like, let's say.
Yeah, what? Yeah. It doesn't matter how high the return is. What matters is what is the ratio, this gas mileage, the return risk ratio.
Got you. Okay.
Right? Because the return may be like 20%, but if the risk is also 20%, this ratio is only 1. Or usually this ratio is actually less than 1. It's between 0 and 1, right? Usually
right.
But the concept is higher the higher this ratio, right? Return risk ratio, which is just like the concept of gas mileage, right? The higher this ratio is, the better it is, because you get the bigger bang for the same buck. You understand? For the same buck, it's better to get a bigger bang. Isn't it right?
Yeah.
Yeah, that's the idea. The ratio of bang for the buck, right? So, but the reason I'm talking about this is because the risks are all different. I mean, if the risks are all the same, if these 10 stocks have all the same risk, then it's easy. You can just pick it by the order of the return, because the risk is all the same, right? But in reality, that kind of situation will never happen in reality, isn't it right? You can deliberately find stocks that have different. You can deliberately find stocks that have similar risks, but they won't be. They may not be exactly the same. But that's deliberately. You did it deliberately. You picked. You picked stocks deliberately that way. But that kind of combination may be meaningless. Why? Because the stocks, that means the 10 stocks that you picked are coming all from the same industry. If they are coming all from the same industry, their risks will be similar, right? If they are coming from the same industry, would face the similar risk factors, so their risks will be similar. I'm not saying they are going to be all the same just because they are from the same industry. Even though they are from the same industry, depending on whether you are a market leader or just a newcomer, there's a huge difference in the risk. I mean, obviously, a startup company in the same industry would have a more risk, way more risk than the dominant player in the industry. You understand? Huh? I mean, obviously, the risk for, let's say, in the mobile phone industry, Samsung and Apple are the two major players, right? Dominant players in the mobile phone industry. Let's say there's a newcomer, a startup. Obviously, the risk factors that this new startup is facing is way greater than the risk factors that the Samsung and the Apple are facing. But let's say they are all pretty much mature companies. There's no not considering the startups, but if you're considering only the mature companies in the same industry, their risks will be pretty much it will vary, but they will be the risk factors will be pretty much the same. But
So I have,
then, then your portfolio, I mean, there's no point in putting all your money into the companies of the same industry, right? Then that's not, diversifying your portfolio. You're putting all your nest eggs into the same basket, and that's something you have to avoid, right? At all cost, right? So if you are selecting stocks from 10 different industries, then you are sufficiently diversifying your portfolio. I mean, to sufficiently diversify your portfolio, it should be at least diversified into like 15 to 20 different industries. But let's say 10 is currently what you have, and 10 different industries. Then you are putting your nest eggs into different baskets. So you will have diversified portfolio, and then you will have different returns and different risks. And then how do you prioritize them? Of course, then return risk ratio. And someone was about to ask a question, right? Please go ahead.
yeah. Hello.
Yeah. Please go ahead. I'm listening.
So it
Is that the
wouldn't
same
be.
person, or
Mhm.
is that the same person or two different people?
It's the same person.
Same person. Okay, so then go ahead, please.
So it wouldn't be smart to like invest in a startup company if because of the risk being so high.
No. Look, the startup companies, you really have to take a huge risk if you're investing in a startup company,
Right.
because startup company is really a big question mark, right?
Yeah.
It's basically just huge risk, and because it's startup, um, you don't know what its expected return is, right? So unless you are a venture capital, you don't do that, right? And venture capitals do that because they are literally venture capital. For their namesake, they are taking the risk. They are on an adventure, purely an adventure, right? Um, and if it turns out good, if it turns out to be a success, then their return will be huge, right? But they are taking a very calculated risk because they have experience. Venture capitals have experience. They know it's a huge risk, but they know it will be but the venture capitals will bail out. Actually, they don't. They're not going to stay with the company for a long time. They will just bail out after IPO, right? Once the company goes public, and they sell off and they bail out because usually, once they achieve their goal, uh, they sell off their shares and they bail out. They only take the risk up to that point, right? But you are not venture capital. You don't have the capability of but you are learning. You're learning to take to calculate the risk, and you will be learning to calculate the return risk ratio. But again, a new startup doesn't have a track record. Think about it. Then you might wonder, how do the venture capitals do that then? Anyway, when they invest in a startup, then it's all the same. They don't have any data, right? Because it's a startup, they don't have any track record. Well, venture capital will look into a similar company that has already gone public, right? But again, that's theoretically, that's theoretically very valid course of action. But then, even if it is in the same industry, even if they are in the same industry, there will be a huge difference between this startup and the company that has already gone public, right? When Google went public, right? Google went public in 2008. there was no precedent, right? There was no precedence, right? Google was the search engine that went public. I mean, Yahoo was the only search engine before Google. I mean, there was, a couple of other like Alta Vista and whatever. But Yahoo was the only solid one. But then between Yahoo and Google, the difference in time. Yahoo was already, Yahoo started out already in 1995 or 95, 96. And so there was like 12-year gap in time, and the economic landscape has greatly changed since then. So Google had no reference, and then after Google, Facebook went public in 2010, I believe, 2010. So that was roughly about 2 years after Google, and Facebook had no model, no reference, and they had to use Google as the reference, but they were two totally different companies. Google is a search engine, Facebook is a social network.
Can I say something?
Yeah. Go on. And who is this?
The reference.
Who is this? I'm sorry, I didn't hear your name. Who is this?
The reference for Facebook was actually.
It was what?
Called MySpace.
That's
what MySpace was before Facebook.
Yeah, but I'm not sure if MySpace went public. I don't think MySpace went public at all. Right? MySpace didn't go public. Or even if it went, and I don't remember it, and MySpace didn't last very long. Of course, MySpace preceded Facebook, but it never went, if I remember correctly, it didn't go public. In other words, it was never there was no stock of MySpace that was ever traded in the stock exchange. Right? So, but the point is, even even the companies in the same industry would have wide variance in their depending on whether they are startup or whether they are mature companies or industry leaders. Mature companies are generally industry leaders and they are dominant players in the industry, whereas startups are newcomers and they will have to face they will have to face more fierce competition because there are already dominant players there, and dominant players will not let the newcomers survive. You understand? The dominant players will try to eliminate the competition from early on, right? So it's totally a different story. And if you are, because someone asked a question whether it's a good idea to invest in a startup. No, you don't do that. Unless you are a venture capital, you don't do that, right? I wouldn't advise because it's a big question mark. It's if you're a novice investor, right? If you're a novice in investing, it's always best to stick with the blue chips, right? Because you will never go wrong with Apple. You will never go wrong with Amazon. You will never. I mean, And Apple and Amazon are, I don't like Amazon as in terms of, I mean, I don't like Amazon in terms of their corporate culture, right? It's not they are not, you know, I don't, many, you know, labor issues, right? They are suppressing the labor movement, and they're not even paying, you know, decent, you know, wage, you know, and they are sweatshopping. I mean, in terms of their corporate culture, I don't, you know, like Amazon, but you know, at least um, you will get if Apple or Amazon, you will get at least annually, like you know. Let me do a quick calculation. I mean, just Apple, because I didn't check Amazon, but at least I know Apple's, not this one. What am I looking at? What's the calculator? Okay, 1.03. Just roughly. Roughly, you will get about 40% return. I mean, if you invest in Apple, roughly you will get about 40% return annually, right? Which is, you know, which is, you know, a very good return. 40% return a year. It's almost like, you know, even the top performers, top, you know, mutual funds, you know, top 10 mutual funds would do about, you know, on average about 30% a year. So 40% a year is a, but anyway, that was, you know, we kind of digressed a little, a lot, not just a little, we digressed a lot. But, you know, that's why this is not the main lecture. This is, as I said, you know, this is collaborate session is more like an afterglow. So we review and reflect on the main lecture that was already pre-assigned. And if this is the main lecture, we cannot do this because we have to stick to our milestones. Otherwise, we won't be able to reach the planned coverage, you know, at all. By the end of the semester, we will be, you know, or even before the end of the semester, even from by the time we have to take the first quiz, you know, we are way behind it if this is the main lecture. But instead, the main lecture is already delivered through the pre-assigned videos, lecture videos, and then in the collaborate we can do we can have these discussions that can enrich our learning, you know, more profoundly. So this is the difference between the main lecture and the collaborate session. Anyway, so I think it's been, yeah, it's 2:07. I think this is the time, right time to, I mean, it's already about 10 minutes past the right time, 20 minutes past the right time. Let's take a 10-minute break because we digressed a lot. I want to come back to our original topic. So let's take a 10-minute break and we'll reconvene at 2:17. Okay, 2:17.
Okay.
Okay. All righty.
All right.
All right. Okay, I'll go to silent mode. 10 minutes. All right, we're back. It took a little longer than I expected, but let's get back to. All right. So, return is basically expressed in percentage, because in a colloquial language, right? What you can say, in a spoken language, you can say, I made, $50 return. But actually, what you mean by that is you made, $50 capital gains, or, proceeds. So what I'm talking about is that when you have, let's say you buy a stock, right? Let's say you buy a stock for $100, right? And a year later, you sell it at 150, right? If you So then, what did you make? You made $50, isn't that right? You bought it for 100 and then sold it at 150. So you made, a $50 gain. Okay. Or the but in a spoken language, they in a colloquial discourse, people just say, I made $50 return. But actually, yeah, in a spoken language, that's what people say. But that's not exactly correct, because you need to say that you made 50% return, right, over that 1 year holding period of the asset, right, 1 year holding period. And not 50, and $50 gain, or you made proceeds of the proceeds from sale of the stock was $50, right? So to be exact, you need to say I made 50% return. Now the reason is the reason the return on investment, or rate of return, is expressed, and it's literally, right? Think about it. It's rate of return, and rate means percentage, right? Rate means percentage. So it must be expressed in percentage, right? And the holding period, we talked about, main lecture, in the main lecture, I already discussed this. Holding period is literally the holding period of your asset, your holding period of the asset. And this can be any length of time. It can be 10 years, it can be 5 years, it can be 1 year, right? Or it can be, even, it can be 15 days, 10 days, even 5 days, or 6 months, or 3 months. Basically, there's no law that says, you have your holding period must be this period, this much, No, I mean, you buy an asset whenever you think is the right timing. The price is right, right? Right timing to enter the market, right? And you sell it whenever you feel that it is the right timing to get out, right? So the holding period can vary between different investors. And of course, investor doesn't mean only, when we say investor, it sounds like a person. No, it's not only an individual, right? It's not only, investors can be either individual or institutional, like, banks, asset management firms, right? Asset management firms, like, wealth management, right? Asset management firms, they are, and insurance companies. Insurance companies are handling a huge portfolio, because think about it, insurance premiums, pour in every month, right? And compare to what they, what comes into the insurance company, they barely pay out anything, right? But of course, they, if it is something like, auto insurance or, uh, or a fire, flood insurance, fire. From time to time, they occasionally they pay out, but it's not like accident is happening every day, right? Uh, of course, accidents happen every day, but it's not like all the subscribers, all the insurance subscribers are having accidents all on the same day, or uh, uh, right. In other words, so what goes out, right? Uh, uh, Considering, compared to what comes into the insurance companies, right? Well, what they pay out is very small fraction of what comes in. But then again, if you think about it, insurance companies are not only doing uh, these companies are not only doing the accidents and fire and hazards, or health, medical insurance payouts, but they are also doing, like life insurance, what I'm saying is, what I'm talking about is not when you're dead, but uh, like, retirement fund. Okay, you understand? Insurance companies are also managing retirement funds. And these retirement funds will have to pay out uh, when you retire, and if you're on on if the average life expectancy is 85, and if you retire at 65, uh, these days people generally don't retire at 65 unless, why retire that early? I mean, if you're, I won't retire if I live up to let's say if I live up to 95, I will work until I'm 90 or 80 something, 88. Because as long as my health allows, right? It's better to have keep getting income every month, right? Rather than relying on just living off my retirement account. Um, as long as health allows, and these days, people average life expectancy is much longer. I mean, compared to like 40 years ago, right? About 40 years ago, 60 was like, very old. Old, old, not very old. 80 would be 80 would be considered very old by the standards of 1980s. But these days, 60 is just the beginning of 60 isn't that old. It's like middle age. 40 when I was in my 20s, 40 was like beginning of the middle age. It meant something. These days, 40 is still, just very active age. You're still young. And middle age, I think, would start these days, only at around, 55 and above, right? You don't, at 60, you're not really old. You're just, in the middle of your middle age. So anyway, life expectancy has, increased a lot, and people are relatively healthier, living a healthier life than compared to 40 years ago. So then, if you can work, if your health allows, why would you retire at 65? But anyway, if if you retire at 65 and if life expectancy is 85, then insurance companies will have to and if your retirement fund is managed by the some insurance company, they will have to pay out monthly, something like let's say monthly, $10,000, for the remaining, maybe not 10,000, but let's say if you have put in, if you work longer and pay into that account more longer, and obviously if you pay if you pay longer into that account, you're paying in more, and then your monthly annuities, what you receive, monthly annuities will be greater. So let's say you're getting $10,000 monthly for the next 20 years. I mean, that's what the insurance companies will have to live up to. They will have to live up to their end of the bargain. So, and they are handling huge, retirement accounts. So they will have to meet this obligation. So all these, insurance premiums that come in, they will have to manage that. They will have to invest it into a. They have the portfolio that are invested into a lot of fixed income assets that can be the source, right, of funds to pay out these retirement retirees, right, from the retirement account. So anyway, the holding period can be anything, any length, and for some day traders, you know what day trader is. Day traders are the investors who just buy and sell frequently, at a very frequent basis, right? So short-term traders are, and usually these short-term traders are day traders are individual investors. Long-term investors, usually the institutional investors, are long-term investors. So for day traders, it can be even a few minutes or even a few seconds. The holding period can be, they just buy and sell, and even in 5 minutes, if the price moved, if the price moved, by 5%, they sell, and they have 5% more, funds now, so they reinvest again, but they do this frequently, and well, of course, there's no guarantee they will always gain, because in the short, because during the day, even during the day, the price movement, every minute, every second, the price movement is very wild and fickle, right? So the day traders are not, I would say, during the day, if they make like 20 transactions during the day, chances are 50% of the time they lose. I mean, more than 50%. I would say 60% of the time they lose. 40% of the time, maybe they. That's still a very conservative estimate. But anyway, the idea is the holding period return is defined this way, and PT. What does that mean? What is PT? Now that P stands for price, of course, and this was in the main lecture. It's just repetitive to say this over and over. P means price, and T, subscript T, the subscript is called time subscript because it represents time. So T generally means the present time, okay? And if our time unit is annual, right? PT plus N means, N years later, right? Again, our time units doesn't have to be only year. It doesn't have to be annual. It could be monthly. It could be quarterly. It could be even daily. But let's say our time unit is annual. So then PT is the price of this asset at the end of this year, right? You might wonder, we're not even at the end of this year. How do we know what? We'll have to assume that we are already at the end of the year, okay? Or otherwise, this is the price at the end of last year, because we have the data of the price at the end of last year. And think about it. At end of last year is the same thing as the beginning of this year. Isn't it right? Hmm?
Right.
Do you follow? Do you get this idea? Do you get this concept? Now, end of last year is the same thing as the beginning of this year. Isn't it right? Because what is end of last year? 12 midnight, December 31st, 2020, right? But isn't 12 midnight, December 31st, 2020, isn't it the same thing as 0 hour, January 1st, 2021?
Yes.
Yeah. So end of the time period is the same thing as the beginning of the new time period. Make sense? So we don't have the end of this year data, but then PT is the price of stock X or any asset X, at the end of the last year. Make sense? Which is the latest annual data, price data we have. Okay? If it is monthly data, of course, it's the end of the last month price, right? Which is also, think about it, closing of, and think about it, closing of the last month, okay, it's not the same thing as the beginning price of this month, but um, that's why we use the end of the month, end of the day, end of the year, right? Of course, in case of stock, every day the market opens, at 9 a.m. 9:30. Opens at 9:30, and then 9 a.m. and closes at 3 p.m. Yeah. Let's quickly check, because it doesn't matter whether it is 9 or 9:30. But and every day it closes at was it 3:33? Let's just check Apple. And then let's see what time it started. 9:30 started. Market opened at 9:30, and it will close at 3 3:50 or 3 o'clock. Okay. Yesterday when it. So this is, this is today, August. Oh, why is it monthly? One day. I believe it closes at 3. Why is this thing monthly? Today is the 30th, and the last day of trading was 27th, right? Last week. Doesn't give you. So let's do it this way by hour. Yeah, 3:30. Closes at 3:30, right? Market closes at 3:30. So think about it. Every day, and then you can tell. So let's. So this was, putting it here. Yeah, okay. 3:30, 27th, right? So 27th. And then you see in the, I cannot move my mouse. If I move my mouse, then it will move away. But you see in the left box, you see open, high, low, close. In the box to the left, upper left, you see open, high, low, close, right? It opened at 148, right? And the highest it reached was 148.67, lowest. So it didn't really move a lot, right? The price of Apple during the trading of August 27th, it didn't really move a lot. Usually, this was very, a low variance, right? And then suddenly it moved a lot today. But the end of that trading, right, on the 27th, Friday, closing price was 148.60. And then suddenly it made a big jump today, right? Open 149, and then it hasn't closed yet. Look, it's just the latest price, right? The most recent. So it's not. It hasn't closed until 3:30. It isn't closed, but the latest price is 153. So after making this big jump, and then it didn't move that much between the opening and. So you can tell from day to day because market closes at 3:30, and the next day it can, when it opens, it can start at a different level. But if you're dealing with annual data, right, or quarterly or monthly data, right, pretty much end of the year, end of that end of that period data, in other words, closing price is the what matters. Closing price is what matters, right? Why? Now let's think about it. On August 27th, right? On August 27th, we had 4 price points, right? 4 price points. But of these 4 price points, which one is the most relevant? Can anybody tell me?
What would be the close?
Yeah, yeah, yeah. It's closing price. And who said that?
Brian.
Brian. Yeah, Brian. So Brian, you got 0.25 for that answer. Yes, closing price is the most relevant. Why? Because nothing else matters. Where it opened and how high it reached, or during the day, during the trading of the day, or how low it fell. It's all irrelevant because closing price is the conclusion of that day's trading. Isn't it right? Closing price is the conclusion. Just the same, annually or monthly or quarterly, it's always the end of the closing price, end of the month, end of the week, end of the month, end of the quarter, end of the year. Always the closing price is the most relevant, right? Because it's the conclusion of all the price movements during that period. So therefore, oh my God, it's 2:47. The class is only officially until 2:40, so we are like currently 8 minutes past the hour. So, but let me, wrap it up. So think about it. If PT is the end of the year data, and last year, so we don't have the end of the year data for this year. So last year's end of year data, that's PT. And then if N is 10, that means 10 years, right? So 10 years, PT plus N is, PT plus 10, then that's the price 10 years after PT. Of course, we are not 10 years after, we are not there yet, but then move this back 10 years then. If this is the price 10 years ago, and then T plus 10, PT plus 10 is the price now, because if this was 10 years ago, this must be now. Then we know this means capital gains, right? The difference between the two is the capital gains. And if our holding period is 10 years, right, that's how much the price has appreciated. And then during those 10 years holding period, right, this is the sum of all the cash flows. In other words, the additional cash inflows, the additional cash flows that this asset has generated. And if it is a stock, then these are the dividends. Okay, so capital gains plus the dividends, and you divide it by. Think about it. That's the only way you can calculate the return, divided by the initial investment. So the first example I gave you was that you bought a stock for $100 a year ago, and then you sold it a year later. You sold it for 150. In that case, what is your return? You made 50% return, or in terms of capital gains you made. And in that example, there was no assumption of dividend, because companies don't may or may not pay dividends. It's not an obligation. Dividends are not an obligation. So you made 50% return, and or $50 gain, capital gains. And when you calculate the return, it's 150 minus 100, so $50 divided by 100, and this term this term drops out because it is zero, because this company didn't pay any dividend. And in that example, it was PT, and this is PT plus 1, because $100 is the price at time t, and 1 year later, 150. So that's PT plus 1, because it's 1 year later, right? Divided by PT, which is 100, right? So that was the case of 1 year holding period, right? But we will need, to consider different holding periods. So we're gonna continue this discussion on Wednesday. Okay, all righty. So I'll have to, well, thank you for staying on. I see only like 7 people, down to 7. And thank you for staying on. And I hope you have enjoyed today's discussion. And so I'm going to stop sharing and stop recording, and I will sign off. Okay. Have a good rest of the day, and I will see you guys on Wednesday.
You too, Professor.
Okay.
Okay, thank you.
All right.
We'll go.
Take care. Take care. Signing out.